Hi, good afternoon, everyone. This is David Clark with the Florida HFMA Education Committee. Welcome to the top of the hour. We're going to give it about 30 to 45 more seconds as folks continue to trickle in. Thank you for your patience. Okay, good afternoon, everyone. Let's go ahead and get started. Thank you so much for attending. Welcome to the Florida HFMA monthly webinar. My name is David Clark with the Florida HFMA Education Committee. Today we have Dave Frank and Tiffany Frank with us to talk about understanding and recouping more value from Medicare Bad Debt. Before we get started with the presentation, I have a few quick announcements. I want to take a minute to thank all of the Florida HFMA chapter sponsors, as you will see on your screen. Without them, we obviously could not be able to offer this fantastic virtual education. As a reminder, if you need CPE credit, you will need to stay on for the duration of the presentation, as well as answer 3 polling questions to get credit. If you've dialed in via phone, unfortunately, we will not be able to track your attendance. So please log in using the link located in your calendar invite. You will receive a post-event survey within 48 business hours that will contain links to the recording, feedback survey, and certificate. As Dave and Tiffany go through their presentation, feel free to enter any questions in the Q&A box on your screen. They will be addressed at the end of the presentation if time allows. However, if time does expire, we'll get your questions to the presenters so they can respond back to you via email, and their emails will be in the presentation. So with that, now I'd like to introduce our speakers, Dave Frank and Tiffany Frank. Dave founded F2 Healthcare in 2012 after working 20 years with nationally recognized Big Four and other professional service firms focused on healthcare advisory and assurance services. F2 focuses on technology-enabled solutions for Medicare Advantage and bad debt, among other technology solutions for healthcare. Dave and team merged with Meduit in February of 2022. Tiffany Frank is the VP of Operations for F2 Healthcare. She leads and provides performance improvement initiatives in the areas of revenue cycle, regulatory reimbursement, finance, quality, safety, patient-centered care, people, and culture. Initiatives are pursued with a focus on information technology and innovation. Tiffany received her BS in nursing from Rush University in Chicago and a BS in business with concentrations in accounting and finance from Indiana University's Kelley School of Business. She is a licensed registered nurse in the state of Illinois. Dave and Tiffany, please take it away.
Great, thanks much. And I always like to answer the first question, same last name. So brother-in-law, sister-in-law, if anyone's wondering. And thank you for the introduction. So we look forward to talking to everybody today. As David said, we merged with Meduit in February. So just so you kind of know who we are, you know, as David explained, we deal with Medicare Bad Debt, net revenue analytics for bad debt, kind of on the back end. Meduit as a company does a lot of different things, very heavy on the back end, which was attractive to us. So a lot of insurance follow-up, early out, you know, self-pay collections, and also a lot of AI work. We have about 1,600 employees nationally, work with over 1,000 providers across the country, and really at any point in time, we're managing $56 billion in AR. So That's kind of enough. That's about us and who Meduit is. What we'd like to cover today, a few specific things. So really, we want to talk about understanding growing patient financial responsibility. And we only have a couple pages related to that, just to kind of frame what is patient financial responsibility, why is it big, and just kind of put some bookends around the patient financial responsibility. Want to spend most of our time and really the bulk of the conversation related to industry changes impacting Medicare bad debt. There's been a lot in recent years, and that's where we'll spend a majority of our time. We'll also at the end talk about timeline considerations. That'll make more sense kind of after we do our discussion, data sets that are applicable, to Medicare bad debt reporting. And really at the end, honestly, as we talk about, these issues, what we're really trying to highlight is, various nuances that occur in the guise of regulatory change, and really, try to focus on, strategies to increase your Medicare bad debt, net revenue reporting and collections for Medicare and Advantage, by understanding those regulations more and taking, action to do different things. So to start, like I said, a couple pages just on teeing up, patient financial responsibility, Medicare bad debt. I think everybody's aware Medicare spends a lot of money, at this point, because this is about a year old, probably $1 trillion plus annually on Medicare. And where we come in and I think where we draw our numbers to try and put a box around it is 25 billion of the trillion really comes from, patients at the end of the day. And of that 25 billion annually, about 3.5 billion or 14% of this total is not paid. So it's due from the patients, it's not paid. And if you claim it as Medicare bad debt, obviously most people on the call understand you're going to get 65 cents on the dollar for that. So that kind of puts some boxes around how much is out there, how much, 14% annually goes to Medicare bad debt. And another key stat is, how much do we kind of perceive as underreported, and why you should, look at some of these things is, on average with a lot of our client base, when we kind of look at what they're reporting, we tend to find 6 to 7% underreporting. So you think 3.5 billion, add 6 or 7% to that, you could see on a national level, there's a fair amount of additional net revenue that can probably be captured, from doing some additional things. So that's kind of a high level. And, since we're talking today with Florida HFMA, we wanted to kind of highlight, some specific numbers for the state of Florida. So a lot of numbers on this page, and that's why we have some boxes to highlight things. So this is from a national database. We have the HICRIS database, and it really gives us all of the deductibles and coinsurance and all of the claimed Medicare bad debt for every acute care hospital in the state of Florida. So if you pull all of them together in a big database, what you'll see here is there's about $1.3 billion per year in Medicare deductibles and coinsurance for Florida providers. If you look at then the claimed bad debt, what that computes down to is very similar to national averages. About 14% of the 1.3 billion goes to Medicare bad debt annually. So in 2020, Florida providers had $225 million of Medicare bad debt. Other things we like to highlight, because, and we do this because we hope that you could take this and look at your worksheet E Part A, worksheet E Part B, look at these state averages for Florida, and this should give you some perspective on are we above or below. A lot of regional things and demographic things kind of play into whether or not you're above or below that line. But really kind of understanding your numbers, understanding that on average, Florida hospitals claim 14.5% of their deductibles and coinsurance as bad debt. And some other stats that we put in here is on a statewide level, this line here, approximately 58% of all the bad debt that gets claimed is tied into crossovers. So when we talk about various regulatory changes today, you should understand that when we talk about crossovers, that really impacts on average about 60% of what you're claiming. The inverse of that, so 1 minus the 57, so that means on average 42% of Medicare bad debt that's claimed in the state comes from all other issues. So when we talk today about agency, indigent, bankruptcy, deceased, and other things like that, it kind of puts a box around why these are relevant. One other stat that we like to look at, and it's kind of just a metric that we look at to understand various organizations, and it's kind of a weird calculation, but if you look at the total deductibles and coinsurance in the state and back off from that, the amount that's already going to crossovers, and then do some math, on average, providers, 6.7% of their non-crossover deductibles and coinsurance are going to bad debt. So again, these are just a couple pages, and that's what we said at the beginning, to kind of frame what are the numbers nationally, what do they look like in Florida. You could look at your specific cost report, or we'll have an option at the end. You can ask us for it if you want it. But this should just give you some perspective about what's going on in Florida and what the numbers look like. Before we move on to some of the industry changes, one thing we do want to point out, and we don't necessarily have numbers, but it's just something to point out to make sure that you're thinking about it, is related to Medicare Advantage. So Medicare Advantage, in a lot of providers, Medicare Advantage is bigger than Medicare traditional. And we do like to point out, if you don't already know, that many of the Medicare Advantage payers do allow for bad debt to be filed. The terms are, very frequently different by payer and provider. And the language varies by contract. Sometimes it's included, other times it's excluded. The rates typically vary. Most of the time they're very similar to Medicare reimbursement, but in general, look to your Medicare Advantage contract, see if they allow for bad debt, and if they do, recognize that the different payers, and we have Humana up here as an example, but the different payers do have requirements. So where everything for Medicare is going through your cost report, worksheet E, Part A and B, if you do identify opportunity with any of your Medicare Advantage payers, most of them have, basically a department that's very similar to a fiscal intermediary, where they have kind of prescribed forms that they like to use, and you have to do the annual filings on those forms. So that's it for numbers and for everything else. And now, we'd like to kind of get into the meat of the discussion. This slide here is kind of just more of a transition slide, and just things we like to point out, that a lot of times people are, organizations are looking at their Medicare bad debt, and what we find is that they don't frequently kind of pause to think about all the things that go on in a typical health system and how they might impact Medicare bad debt. So things like new staffing, which is obviously a real key issue today. Staffing is very tight, and there's a lot of new models that are being developed. People are moving to outsourcing, if they can't fill roles internally, onshoring, offshoring. And as those people change and or the processes change, that's where issues occur, and that's where problems occur, frequently. Is that, they're not that familiar with things that might go wrong. Similarly, affiliations and mergers, when organizations adopt another organization's policies or procedures, what's happening down the road in the RCM function related to all these issues that should be accounted for. Agencies, so if you change agencies, if you change your policies with agencies, if you don't reconcile with your agencies, there's a lot going on back and forth with your agencies that you should be keeping tabs on, because it really impacts your Medicare bad debt reporting. System upgrades, I think it goes, without saying that if you change systems, if you upgrade systems, move things over, though, it just fundamentally changes all of your reporting for Medicare bad debt. And just something to think about, annually. I think the bulk of what, we'll talk about today is, the regulatory change. These are the things that are, I would say, as reimbursement and finance professionals, are kind of in our control. Affiliations and mergers, for example, impact a lot of things, but we don't necessarily have, a lot of control over what goes on day to day there. But really understanding the regulations and some of the risks that might be occurring with the regulations, I think, is where we can, really make a difference. And that's what we'll focus on today. With that, I think we'll pause for our live polling question. So question one, and we more like to kind of just understand how everybody, how these issues impact your organization. So how does your organization primarily manage Medicare bad debt analytics and annual reporting? So, do you do it internally with internal teams, consultant-based, technology-enabled services, some mix of the above, or don't know and or don't report? Give everybody a couple minutes to answer, or a minute to answer. All right, so these are the results, largely what we expect. We work with a lot of providers across the country, and honestly, the highest answer, a mix of the above, is very frequently what we see. So even if done internally, kind of a consultant, looking over things, and very consistent with what we see. All right, so as we kind of jump into things here, and I'm hoping this is as we kind of jump into the regulatory piece, we like to kind of step back, and because we're going to talk about crossovers, indigent and agency, but we really like to kind of put a perspective, on these issues, and and where we see and how we perceive regulatory change. So almost everyone is familiar with, obviously, final rules that come out. That is the primary driver of regulatory change at a national level. Most of what we talk about today, the 2021 final rule and how that's played out, there were very substantial changes that we'll talk about today. And really the FY22 and the proposed FY23 that are out, minimal to really no changes that impact Medicare bad debt. But what we like to do, and what a lot of our comments are kind of based around, is really kind of extending those final rules to to really kind of see what is playing out nationally with respect to those rules. So the rules come out, but we've seen varying retroactive, modified regulatory implementation of those rules. A lot of times the rules really vary by fiscal intermediaries. They're applying for example, new rules to old Medicare bad debt laws, or they're applying uncodified rules by region. So an uncodified example would be zero balance on agency. That was a national kind of issue. It really, frankly, has never been codified, but intermediary by intermediary will implement it. And then there's other things. So, crossovers written to contractual allowances, first bill to patients, the whole concept of indigent, charity, and presumptive. Those are really playing out differently by fiscal intermediary, and kind of understanding the nuances with those, we think is not technically in the rules, but it really does influence how things play out. In addition, the S10 audit and review process, most of you are obviously aware, those audits are occurring a lot faster than the traditional cost report audit and the Medicare bad debt audit. So, how do those play out, and how does that impact things? It's not really a rule, but it does really influence what you do. And then finally, legal challenges that are occurring. Those, they are what they are. They very frequently happen for a lot of different issues. And so a lot of the things we talk about today are in motion. They're changes are happening within your organization, are occurring. And at the same time, there's legal challenges that are occurring related to a number of these things that we're talking about. So it really is, for your specific agency, really kind of understanding in context, what are the final rules? How is my fiscal intermediary rolling out those rules? S10 as it's applicable or not applicable on an interrelated basis to your organization. And then, as I said earlier, just legal challenges and keeping track of those, so that if any of these things are an issue in your particular region, and you do have audit adjustments, that you're kind of keeping track of those, because they might come back around later. So we've kind of tailored a lot of our comments to really highlight some things to be thinking about, related to this and how they've been playing out in practice. With that, I'll turn it over to Tiffany to talk about crossovers.
Thanks, Dave. Appreciate it. So relating to crossover accounts, I'd like to spend my time today to walking through 3 key trends that we're really seeing relating to these crossover accounts, spending the majority of my time on this first one being crossovers recorded as contractual allowances. And then secondary, I'll spend a few minutes talking about Medicaid managed care and out-of-state Medicaid payers, also some non-covered service denial trends that we're seeing, and then also how we're seeing the handling of Medicaid spend down in the industry. So by way of background, crossovers refer to patient accounts that are Medicare primary with either traditional Medicaid or Medicaid managed care as that secondary payer. And historically, as long as the provider could show proof that Medicaid was billed and could provide an EOB or a remit that supports that crossover write-off, so a valid denial that shows it's a valid crossover, crossovers passed audit without any sort of issue. Where the crossover was actually recorded was not really deemed material within the industry. Medicaid has been seen traditionally as a contracted payer, so recording that Medicaid portion of the account as a contractual allowance was acceptable practice, and the auditors were not looking at it any differently. However, in the 2018 and 2019 time period, Palmetto, which was in jurisdiction M, began disallowing crossovers that were written off to contractual allowance accounts. It was appealed to CMS, and CMS clarified what they called, quote unquote, a longstanding policy in an MLN Connects publication in April of 2019, which ultimately has led to these national changes. Next slide. Thank you. So CMS basically came out and indicated that a contractual allowance is a contra revenue adjustment, which offsets the revenue account on the income statement. As such, because of that, there would not be a corresponding bad debt expense And therefore, they're saying that recording crossovers as contractual allowance would not make them allowable as Medicare bad debts. So with the federal fiscal year 21 IPPS final rule, they basically codified their stance in the regulations on that issue. They did a little bit of a revision to incorporate verbiage allowing quote unquote implicit price concession instead of only expense write-offs to better align with the GAAP requirements. And those changes were made effective with cost reporting periods beginning on or after October 1st of 2020. So federal fiscal year 2021. Whether it's effective 20 or 21 or as worded 19, that's a bit of a gray area by fiscal intermediary that we're seeing in the marketplace as to when they're actually applying this no contractual rule. Some are retroactively applying it back 19 and even prior to that. Some are starting with the federal fiscal year 21 reporting year. So with that, audit review issues, adjustments will obviously come appeals, reopenings, and litigation. So it's really important to understand how your FI is actually treating this regulation and when they are applying it. So things to think about when we think about the need now to write crossovers off to actual crossover bad debt accounts. There's 4 different areas that we look at as far as implementation and just ongoing issues. First off is the transaction code description and the general ledger financial statement mapping. In this case, Medicare regulations tend to get a little bit sideways with financial reporting. That's probably been in place at many of providers for years, and it's difficult to unwind kind of the different challenges. The key here is to understand what your transaction code is. In that transaction code description that you're using to write off that crossover, make sure that it doesn't say allowance or contractual anywhere in it. That transaction code description should say something to the effect of crossover bad debt or something like that. And then understanding how that rolls up into your general ledger and financial statements, and make sure that those follow those Medicare regulations, being that they roll up into that quote unquote implicit price concession on your general ledger accounts. And then number 2 is really understanding how big of an issue it is at your organization. Have you implemented the change? Maybe your organization has never written off crossovers to contractuals, or maybe your organization has implemented that change, but it was implemented, within the last year or 2. It's really important to just understand when the change was implemented, and are there any years impacted that could be at risk during reimbursement. We've encountered some situations where there's thousands upon thousands of accounts that are impacted that. And we've also encountered situations where the changes might not be 100% rolled out, for instance, due to system conversion. So maybe you have an old system where contractuals were being written off to an allowance account, and maybe your new system, they're being written off and rolled up to the correct account. So just understanding what sort of backlog exists on incorrect accounts, and then understanding a go forward plan to make sure to correct those accounts. Number 3 is things still go wrong. Even if we do number 2 really, really well, there's things that still go wrong, and we still see seepage. And so that is just, there's the one-time kind of transition to just make sure that we're reporting these correctly. But we don't see this issue as just a fix issue and move on. What if misclassification continues to occur? One of the biggest things we see is, what about staff turnover and education? So for instance, if your system is, if you're manually posting crossover write-offs in your system, there's staffing education that must occur. And what if there's turnover? We do see this particular issue as a long-term opportunity for AI or robotic process automation, which takes a lot of that manual issues that could go wrong right out of that. So make sure you have a plan of how you will be addressing, and then what's the plan to monitor, correct, and then just to continue monitoring. And then, as Dave talked about a little bit relating to S10 and uncompensated care, how does that how does that fit in? In our experience, if crossovers have historically been recorded as contractuals, organizations then have historically missed claiming those on S10 and on that line 26 relating to bad debt. So this is something to think about and make sure that there's a corrective action in plan so that all of that uncompensated care reporting can be reported in the correct place. From a prospective consideration and planning perspective, first things first, we have found there's a lot of recourse in just level setting and documenting the status of the issue, and then being proactive and having a discussion with your fiscal intermediary, again, as deemed applicable, depending on your relationship with that fiscal intermediary. Like I talked about before, understanding how they're applying retroactively or prospectively the crossover issue. And if you feel like you do have a retroactive crossover issue, getting out in front of that with the fiscal intermediary. We've seen some providers be successful in documenting a corrective action plan with their fiscal intermediary that does not require them to go back and back out all of those accounts and put them to a different code. We've seen some corrective actions that have worked with fiscal intermediaries, for instance, just doing some reversing journal entries and things like that. So being proactive, actually, we've seen can be very helpful in this situation. And then along those same lines is if doing nothing could potentially, there could potentially be ramifications for audit adjustments on those retroactive logs. So just making sure where your issue exists and obviously elevating that up, to the appropriate levels in your organizations if you do feel like there could be potential audit issues on some of these older logs. I also talked about monthly, quarterly monitoring of known issues with those corrective actions. Like I said, it's not a one-stop shop. Once it's fixed, we found that there should be more monthly and quarterly monitoring, and then even yearly monitoring. And that's the number 3. Really looking at your Medicare primary population with Medicaid secondary, again traditional Medicaid, and your Medicaid HMO secondary. Review all those write-offs, ensure that they pass the sniff test as far as what was written off from a contractual perspective versus what was written off to the correct contractual account. Again, any sort of system conversions or clearinghouse changes that drive write-offs should pique your interest, and make sure that you go back to number 2 and do that monitoring of those conversions or of any sort of clearinghouse changes that drive those write-offs to ensure those crossovers are being written off to the correct code. And then lastly, given many of the issues we've highlighted here, we're sure that there's going to be legal challenges, especially as it relates to some of this retroactive application. So if you do have any sort of audit adjustments relating to this, we would just recommend making sure to keep documenting the steps that you're taking along the way, so that if there are any legal ramifications, that you're able to get back some of that reimbursement, you have that avenue. That's the majority of what I want to talk about relating to crossovers, written off as contractual allowance. A couple other trends that we're seeing, while not regulatory driven, we feel important to keep a pulse on. Crossovers should be considered crossovers, regardless of whether they're traditional Medicaid or the MCO, whether they're paid or unpaid, out of state or other. It's just important to try to be consistent across these type of adjustments and the support you gather for audit purposes. So you want to use the same sort of codes that are mapped to the same sort of journal accounts. You want to make sure that you have the EOBs documented that show the valid denial, just like you would on a traditional Medicaid. We find that oftentimes these non-traditional crossovers, so these Medicaid HMO plans or these Medicaid out of states, they're either missed on a Medicare bad debt log, or if they do appear on a provider's logs, oftentimes we find that providers are unable to support those in the same way as they are the traditional crossovers. And again, with payment denials, spend downs, there's certain states that are now covering Medicare allowed services where Medicaid might not be what we're calling them non-covered services. An inpatient psych unit is a good example. There are recourses to being able to claim those as crossovers as long as the proper documentation is there. And same with the spend down. As long as you're not claiming that patient spend down amount as crossover, you should be able to claim the non-spend down amount as a crossover, just using your regular crossover code, and then any patient spend down amount that has went through your traditional collections process should be able to be claimed then as kind of a regular and agency account on your bad debt. So I hope this provided a good overview of crossovers as contractual and some of the associated topics you should be considering as you address this today and then ongoing. And then Dave, I think he's going to get into indigent now.
Yep, thank you. So the crossovers, as Tiffany alluded to, the lines have been pretty black and white in terms of like where the biggest risk is, as she alluded to. Some of these prior periods and any big lingering issues that might be out there, that that's where big surprises could come in. If you have any of this stuff historically and you really haven't worked it out with your intermediaries, people most of the time don't like surprises in financial reporting. So really getting on top of that is key. The next area, related to indigent accounts, is one. It's much grayer, and we could probably do a whole presentation on just this discussion. But we want to highlight kind of a couple things that we're seeing, just related to the whole topic of indigent accounts. We've had clients clipboard and state, what the regulations say, that when they were published, charity is not allowed, presumptive charity is not allowed. And it really brings us back to when we're talking about Medicare, really focusing on indigents. And, we have a number of comments, but in general, when we're talking Medicare, we're talking indigents, not charity and not presumptive charity. And we'll give some thoughts on this as we jump into it. So to start, from a historical perspective, what we see in a lot of the conversations we have with health systems we work with is the issue is there's been a kind of a long-term blending of terms in a lot of policies, procedures, and other operational guidebooks. It gets fairly gray in terms of what charity versus indigent versus presumptive charity. Most people in kind of a common definition really, blend these topics together. They tend to think that they kind of mean one and the same thing. And even the financial reporting, a lot of the transactional write-offs that are frequently used use the same codes regardless of payer or definition, and there's really not a lot of differentiation. So the 2021 regulations, highlighted charity care is not allowed for Medicare, and presumptive eligibility tools cannot be used for Medicare indigence determination. And those words are pretty bold, and it's tended to create a lot of confusion as to like, well, what does that really mean? Layer over the top of that, the S10 and uncompensated care items that kind of play into this, like how you use these terms for S10 versus Medicare. It really tends to create, a lot of confusion. So clearly defining these terms and their use in the RCM function are, in our opinion, are kind of critical go forward issues if you're going to claim this as Medicare bad debt. Almost 100% of the time, in our opinion, these three items have very different RCM roles, and timing and documentation could drive those roles and those issues. So the regulation, very quickly, as I just alluded to, within the regulations, charity care is a reduction of charges. So, and that's what we think is kind of critical to understand, is that charity care involves reduction of charges, and there's some other things that we're going to talk about, but it really is not a deductible and co-insurance, type of thing. It's a reduction of charges that cannot be claimed as Medicare bad debt. So that's kind of understanding number one. Number two, in the regulations is then Medicare gets into the whole concept of explaining that, but indigence is allowable. And indigence, if you determine indigence with a patient, those may be deemed as uncollectible. So the terms are very different, with charity care dealing with charges and indigence dealing with uncollectible, balances that are determined. And we're going to get into that and kind of give our, perspective on these items. So as we said earlier, contractuals of crossovers have been easier for providers to get their hands around. These issues have a few more tentacles. And the key discussion items that, we would put kind of around this topic is Medicare in general does not, as we just alluded to, does not use the term charity or presumptive charity when discussing Medicare bad debt. So for most of our clients, we've moved towards removal of these terms anywhere in the Medicare conversation. So the labeling of logs, just the conversation with a fiscal intermediary. If you say, well, we write these off to charity, it's going to be an immediate kind of steering the conversation in the wrong direction if you're using those types of terms with Medicare. Indigence, and that's our point number 2, indigence is the key Medicare term to use, and indigence is determined by documenting things on an application for financial assistance, not charity, financial assistance, by the hospital's determination of indigence with the application materials or some other associated procedures like presumptive scoring tools. Policies and procedures and associated write-off codes are critical longer term, as we've kind of explained. So really, understanding your policies and procedures and understanding how your write-off codes tie to those policies and procedures, is kind of really important. And number 4, and we'll talk about this a little bit, but 120 days and reasonable collection efforts really, drives, a lot of things. So the after 120 days, for Medicare purposes, you've done reasonable collection, you've done letters, you've met Medicare, largely criteria. So as an example, and this is where it starts to kind of blend terms a little bit, if you use a tool to determine presumptive indigence after 120 days, and you decide after 120 days that you're not going to pursue additional collection efforts, you're really making a business decision at that point. You're not using the presumptive eligibility tool. Really, in the first 120 days, you're trying to collect from the patient and you're trying to do things. You're really using it as after you've met all applicable Medicare criteria, and after you've done all your efforts, and you're really using it not to determine anything related to the balance. You're just using it for all patients to determine whether or not you want to send that account to collection. So those are a lot of different things. I think that the key things that we would point out when we talk about indigence as a Medicare term and it relates to financial assistance is, and we talk about insured here. So other comments we would make is that, uninsured patients receive charity and uninsured discounts in most financial assistance, or, in most policies that we see. Insured patients, in most policies and procedures that we see, insured patients typically receive financial assistance once a level of indigence is determined. And so kind of a key takeaway is putting charity care and presumptive charity into its own box related to uninsured patients and uninsured discounts and various uninsured things that you do, and really put into a separate box the determination of indigence anywhere in the process related to insured patients, or after you've already pursued some collection efforts. Really kind of put those into their own box as indigence determination after it. Indigence is allowed, charity and presumptive charity is not. And again, a lot of things occur, as we mentioned earlier, with the codes that are used and kind of getting your code structure settled. And that's what kind of plays out and it's very similar to the crossover comments that we made. So prospective planning in this area would really focus on everything we just said. So kind of level setting and documenting status of this issue, within your organization, really having a discussion of what do our in number two, what do our policies and procedures say related to uninsured patients and charity and the write-offs they get? What do our policies and procedures say related to insured patients and indigence determination and the discounts that they see? And really kind of understanding the policies and procedures and setting the associated write-offs in alignment with what Medicare wants to see. Implementation as needed of regular accounts, that's what we described earlier. If you pursue, bottom line is if you pursue collection for 120 days, if you send, Medicare's requirement for reasonable collection efforts is 120 days of effort. So if you pursue collection for 120 days, if you send statements, if you send bills, you send texts, and really our opinion is after 120 days, you could really do whatever you want. You could determine which accounts you want to send on to further collection, which accounts you don't. Obviously, as long as that applies to all patients, you can't just do that for one set of patients, but really, understanding the policies, procedures, the write-offs, and then implementing, similar to crossovers, doing, monthly, quarterly monitoring of this. We do think this is another area with very high AI and RPA possibilities to kind of keep things into the right bucket and identify them in a more timely manner. And finally, because it's out there, keeping track of, as we said with crossovers, keeping track of legal challenges pending. Hopefully most of you saw there was a Centera case that was settled back in the the March, April timeframe. I would encourage everybody to read that. It had very specific things related to everything we just said about using presumptive eligibility tools and when they do that. Centera was successful in that case. It did relate to older periods, but we do think that will have some precedence going forward to to future litigation. So with that, I'll turn it back over to Tiffany.
Thanks, Dave. So I want to talk a little bit about your self-pay and agency accounts, highlight 3 areas where we're seeing trends and changes in that area. Dave really covered the use of presumptive eligibility tools in detail. I'll highlight for a second the timing of how those tools impact your self-pay accounts. He talked about that a lot. Also touch on some newly codified regulations around billing the patient within 120 days, and then talk a little bit about some trends we're seeing relating to zero balance on the self-pay accounts. So as Dave talked about, I'm not going to go into big detail. He talked about it a lot, but the timing of the use of these presumptive eligibility tools can impact whether an account can be claimed as Medicare bad debt or not. As he said, as long as your collection policy is followed, you've performed that 120 days of collection efforts, then it is acceptable to use a pre-agency scoring system to make business decisions on accounts that should go on to bad debt collections, and then accounts that you're going to go ahead and deem as uncollectible at that 120-day mark. Accounts meeting your internal collection that have been deemed eligible for write-off at that pre-agency scoring point should be claimed as regular self-pay on your Medicare bad debt log, and then accounts that go onto your agency and come back as uncollectible would be categorized as agency on your log. So prior to federal fiscal year 21, Medicare regulations merely stated that a patient should be billed within a quote unquote reasonable time after the Medicare payment. And this test of reasonableness was largely FI specific, with some FIs not looking at this metric at all, and some applying it anywhere from 90 days to 150 days after the Medicare payment. So with the federal fiscal year ruling, it codified the requirement to be 120 days. And what's important to remember for your organization is that auditors will accept support showing any reasoning as to why the patient may not have been billed before 120 days. We have some examples here, but for example, maybe you were pursuing a secondary insurance or pursuing Medicaid eligibility, or maybe the patient was applying for financial assistance. So as long as you're able to support that longer than 120 day bill, the auditors are fine. What they're not going to accept are system related issues, such as the balance not dropping from a payer bucket into the self-pay bucket, triggering, a self-pay cycle or anything like that. Next slide. Relating to the zero balance on accounts, in general, if an account is deemed uncollectible and eligible for Medicare bad debt, that account balance should be at zero. We've started to see some issues. It started in jurisdiction M, where the FI was looking at agency accounts that were at a $0 balance in the active AR system, but still had a balance on the bad debt AR, and we're disallowing these as not being deemed uncollectible since there still was a balance on that account. This, I think Dave talked about this before a little bit. This has not been codified in any Medicare regulations. There's challenges and regional discussions underway on this issue as well. For many patient accounting systems, Meditech, Cerner, Sorian, it makes business sense to keep the account balance on the bad debt ATB after an account might be returned from agency. For instance, they're there for future reference. In some instances, especially in the Meditech world, if the account goes to zero, the system has a purge feature or an archive feature, and the details on the account wouldn't be available for audit or to be able to be reviewed in the future. So there's all kinds of reasons why providers might make that decision not to have that account down to zero balance. And again, we would just recommend having those kind of conversations with the FI if they come up at your FI. When you make sure when not to claim would be when the account is moved from the regular AR to the bad debt AR. And the account is still at collection. So the FI is definitely going to look at that. They're going to want to make sure that any sort of account you're claiming as, a quote unquote agency is being claimed when it's returned from that collection agency and all efforts have been ceased. That is different from an S10 and uncompensated care recording when they want that recorded when it goes from off of that regular ATB. There is a sensitive issue that could kind of come up in these sort of discussions. If a provider is retaining these accounts on their system in the bad debt AR for long-term reactivation, and using that if the patient is presenting for future services, then to collect on that bad debt. For instance, if the patient owed $100 from 5 years ago and they present now and that bad debt is being reactivated for payment, there is an issue where we could see an FI might consider those as being active. So that might be something to just keep into consideration from a policy perspective. And then relating to regular accounts, I'll mention this, it's limited in its incidence, but we have seen issues with FIs where if a partial portion of the deductible and coinsurance is being determined, let's say $100 is being written off at that pre-agency scoring point, and then another $100 is going to the agency based on those tools that a provider is using. We have seen instances where the FI have been arguing that that entire $200 should not be claimed until the full deductible and coinsurance balance has been deemed uncollectible and put down to zero. So for instance, if that $100 is being claimed in 19 and the other $100 is in 21, we've seen FIs want that entire $200 to be claimed in 2021. So that requires tracking over a few collection periods. Not a huge incident yet, but just wanted to bring that up. I'll spend just 1 minute on this slide because it's just super important just to remember from a timeline consideration and how we're handling our agency and our regular analytics. Days 1 through 20 after that Medicare payment, you're doing your internal, your reasonable collection efforts, you're doing your statements, your calls. Any write-offs that occur before this 120-day mark tend to be hard to document unless there's certain specific instances met. So if you're claiming the account is indigent based on bankruptcy and deceased and you have good documentation, that's fine. But in general, it becomes a lot easier to document an account for Medicare bad debt after that 121 days, because we've met those reasonable collection efforts that are codified in the Medicare regulations. So that's when any sort of pre-agency scoring can occur, and the business decision can be made whether it gets passed on for additional collections to your bad debt vendors. And then when you go to agency, very important to remember, you have to apply all policies and procedures relating to any sort of collections that you do and any sort of bad debt vendors that you have to all payers. You can't send non-Medicare to a secondary bad debt vendor, but send Medicare only to a primary. And the FIs are looking at that stuff during audit. And then it's just very important to really understand what your agency models look like. How long are your agency hold periods? Do you have primary agencies? Do you have secondary agencies? And really to just do a cost benefit analysis by facility to determine, how long should these accounts be held, versus extending the historical amount that you can claim as Medicare bad debt. How long do you want to extend that out versus when should you expect to get paid on this stuff? And then it's generally okay to do segmentation of accounts as long as they're not done by a payer. So for instance, accounts on a payment plan might stay at the agency when accounts not on a payment plan may come back. Or accounts over a certain balance may go to a secondary agency, whereas accounts, lower than that balance would only go to primary. That is okay if it's A, in your policy, and B, if it's you're treating all Medicare and non-Medicare the same. I think we got our polling question.
Yep. So now we'll do polling question number 2. Which regulatory changes have most significantly impacted your organization for Medicare bad debt? And we have the crossovers, indigent accounts, billing requirements, all of the above or none of the above. All right. All right, I think we can give everyone one more second here. So it's good to, we would expect crossovers was the largest. That is generally what we have seen. All of the above is the more common, and none of the above, you're in fantastic shape. So that's good to see. So we have a couple minutes here. So the remainder of our slides here, and we will have this available for everybody, but if you're kind of looking into any of these and tracking things for your organization, we like to provide an example of, the types of things that you should have at your disposal. So, things like your historical bad debt logs. We would encourage people to really keep a running log of those in a database, really for all the different periods that you're looking for, to look for duplicate accounts, to, just to catch things historically. And then a lot of these things we talked about tracking the contractuals, tracking the issues, understanding kind of the various codes that are occurring, using your decision support systems to have some of these different types of files available, we think will help you, develop kind of a good internal program. Outside of that, we do have a number of comments. I think with time here, we won't go into a lot of details on these, but setting up your internal system should be, simple, accurate, speed, automation to kind of, try and do, and we said before, try and do a lot of this stuff as proactively as possible. And then finally, what I will comment on is the just what to look at when you're developing your team. So your technology should give you, and those reports that we just mentioned should really give you kind of a full view of everything that's occurring. You should have a lot of automated compliance checks. So those 120-day billing requirements, looking at how things are reported in the S10 versus your bad debt. A lot of that stuff should just be built in and programmed, within your system. From an expertise perspective on your team, really, developing out, the industry expertise you need and attending. I think, we thank everybody for attending today's session, but, doing a few sessions like this per year and or having subscriptions to various, periodicals will really develop, and deepen the expertise of your team. So you're kind of bringing different sets of issues, to your organization. And then on the service side, what I would say there and what becomes a very good skill to have within your team is really just kind of softer skills. So, spend some time training on how to deal with the fiscal intermediaries, the things like we talked about, just the do's and don'ts, today in today's age, not mentioning charity and presumptive charity. They're not going to really like those terms. And, just thinking through some of that proactively as you talk with fiscal intermediaries. So last polling question, what applications does your organization use, for Medicare bad debt analytics and compliance? So are you using, system generated reports, Excel, Access, any sort of integrated products, or, anything that's different? We'll give this one less time. We'll try to get through it quickly. I know we have to do it for the CPE, so we'll put up, as soon as we have enough in, we'll put the poll up. So yeah, very good. So, system, internal reports in Excel, that's what we would expect to be the hire. So in closing, last item that I would highlight, 2 pages. So we hope you enjoyed this. We thank you all for attending. The things that we would think about, that we're keeping on our radar are, these issues related to crossovers, understanding the indigent versus charity versus presumptive, the new compliance requirements, the legal pipeline. Longer term, start to think about how you could catch some of these things with AI. Lots of organizations have lots of initiatives for AI and RPA. If they're looking for things to bring to your department, hey, what are we using in finance and reimbursement? We do think this is a good thing you could bring to the table, and we've given some examples here. And finally, I know we're not going to have time for questions because we're at the time, but if you do have any questions, specific questions, you could contact me internally, or there's contact information for Medicare in general. We talked about those facility-specific numbers. If you'd like to see your numbers by hospital, we could provide that to you, or you could just contact me and I'll get it to you. So we do appreciate everybody's time today. With that, I'll turn it back over to David for closing comments.
Yeah, very good, Dave. Thank you very much, Dave and Tiffany. We greatly appreciate the time. We appreciate the presentation and content. I know we're over time, but as a reminder for the attendees, you can find the presentation from today posted on the Florida HFMA website. So Ben and Tracy, I do see your questions. Feel free also to reach out to Dave directly. He did say we could do that as well. Again, please keep in mind that you'll be getting a survey in the next 48 business hours. I'm not going to go into the HFMA membership as we're over time, but please take a look at that. We've got our fall conference coming up in a few weeks. Registration is getting close to closing, but take a look at that. We hope to see you there. And of course, thank you to all of our sponsors. We showed the slide at the very beginning. Again, we cannot have these presentations without our sponsors. So our sincere appreciation to them. Dave, Tiffany, thanks so much. Again, on behalf of Florida Chapter HFMA, we really appreciate your time and the content shared. We will see you at the conference or on the next webinar. Everybody have a good day.
Thank you.